Hey, I hope you're doing great. I hope you're finding the weekly rate updates useful. Just wanted to take a couple minutes and go over some of the differences between Fannie Mae and Freddie Mac. I included that in last week's rate updates and then also in the rate update this week. Just starting over here, Fannie Mae allows for up to 10 finance properties. Another big change that occurred back in August is if somebody had a mortgage that they included in their bankruptcy, we can go off of the bankruptcy discharge date, so 4 years from the date of discharge, even if the foreclosure proceedings happened after the bankruptcy was discharged. So with Fannie Mae, you don't have to go off of the trustee deed date. Basically, it's included in the bankruptcy, and we have to go 4 years from the date of the bankruptcy discharge. So that one's a pretty big change where previously everything was off of the date of the trustee deed. Limited condo reviews is also allowed under Fannie Mae guidelines. What that is you're typically going to get that on any owner-occupied or second home transactions where the borrower is putting a 20% down payment into the transaction. So what limited review allows for is basically we're just looking at the condo questionnaire to make sure there's no pending litigation for the association, and then also a copy of their master insurance policy just to make sure that they have the insurance requirements in place to meet Fannie Mae guidelines. So Fannie Mae also allows for rental income to be used on a purchase. So if you have somebody buying a rental property, we can have the appraiser do a rent survey or a 1007, and then we can use 75% of that fair market rent amount to help offset the monthly payment. So pretty big one where Freddie Mac requires rental history and then doesn't allow for that future rental income to be included in the transaction. Freddie Mac allows for blended debt-to-income ratios for non-occupying co-borrowers or a co-signer. So where Fannie Mae, the occupying borrower, still has to qualify for the payment, Freddie Mac allows us to include that income to basically help qualify the borrower for that transaction. So they also allow for future employment income to be used based off of an employment contract. So as long as we're within 60 days of that contract start date and there's no contingencies on the contract, we can use the future employment to qualify somebody for a new mortgage. So Freddie Mac also allows a little bit higher debt-to-income ratios, right borrower, reserves after closing, good credit profile. A lot of times we can push the ratios higher than a 45% if we need to with Freddie Mac guidelines versus Fannie Mae, where Fannie Mae typically cuts off at like a 45% debt-to-income ratio. Freddie Mac, you can sometimes get it up to like a 50%. Freddie Mac also has higher loan-to-values on adjustable rate mortgages than Fannie Mae, where Fannie Mae requires a 10% down payment on an adjustable rate mortgage. Freddie Mac still has a 5% down payment program. So that's just some of the differences between Fannie Mae and Freddie. And then the next slide here just included a success story for this month. Again, just kind of going with the differences between Fannie Mae and Freddie Mac. Transaction that we worked on here was a detached condominium. Purchase and sale was received on October 28th. Inspection contingency was satisfied and we ordered the appraisal on November 3rd. Initial underwrite completed on November 5th, and then we received the association information, and going through everything, the association didn't meet Freddie Mac guidelines, so we were able to switch it over to Fannie Mae guidelines, get the association approved, where some of the other big banks in the area, maybe even some of the other mortgage companies and that are underwriting only to Freddie Mac guidelines would have had what we call like a non-warrantable condo. They wouldn't have been able to complete the transaction just because it did not meet Freddie Mac guidelines, and there wasn't really any way to adjust anything with the association to get that approval. So we're able to underwrite to Fannie Mae guidelines, sold direct to Fannie Mae, and we had docs out to escrow on the 11th business day. So even with Veterans Day in there, we're still able to get loan documents out to escrow 1 week prior to closing. Really helped out, especially in this short month where get the documents out early, gives escrow a chance to set the appointment and that, and they were able to get everything set up before the end of the month rush occurred. So again, just we always focus on getting those documents out to escrow at least 5 days ahead of time, 5 business days, typically a week before closing, which gives escrow enough time to get the appointment set and just kind of keeps everything real comfortable towards the end and able to not get caught up in that end of the month rush. So Another big change coming up first of the year. Fannie Mae, Freddie Mac are going to increase their loan limits. This is for the conventional conforming high balance loan program. Typically minimum 10% down on these products, but King, Snohomish, and Pierce for 1-unit property, increasing the loan limit to $517,500 from $506,000 currently. On a 2-unit property, you can see $662,500. 3 units going to go to $800,800, and a 4-unit will be $995,200. So I hope everybody has a great Thanksgiving. Again, I hope you're finding the weekly rate update useful, and don't hesitate to give me a call with any questions. 425-698-2917. Thanks, and happy Thanksgiving.